You know, in finance, just like in physics, there are some laws you just can't break. You can try to defy them for a little while, sure. You can build up the hype, you can tell a great story, but in the end, gravity always wins. And today, we're talking about the law of financial gravity.
This sentence right here, this is pretty much our entire focus today. It is the core principle. You can have the most amazing story, you can generate all the buzz in the world, but if you break this one simple law, well, gravity wins.
And to see this law in action, we're going to look at a really fascinating real-world example. It involves an Australian company called Reece Limited, and it is the perfect case study.
Okay, so this chart, it's a genuine puzzle. Let's break it down. Take a look at that blue line. That's Reece's share price. From 2015 to 2022, it was an absolute rocket ship. The story was incredible. But then, look at the purple line. That is the company's return on its own investments, and it's been sinking for nearly a decade. This makes no sense, right? How on earth can a stock price fly to the moon while the actual business is getting less profitable? That's the mystery we've got to solve.
To solve that puzzle, we need to pop the hood and unpack the math behind this chart. This is where we get into the real nuts and bolts of what it means for a company to create, or in this case, destroy value.
All right, first up, let's talk about return on invested capital, or ROIC. Put simply, for every single dollar a company invests in itself, building new stores, developing new tech, how much profit does it actually make back? That's its ROIC. And on our chart, that is that sinking purple line. Reece was getting less and less bang for its buck.
Now, on the other side of the coin, we have the weighted average cost of capital, or WACC. So if ROAC is what a company earns, WACC is what it costs to get that money in the first place, whether it's from loans or from investors. On our chart, that WACC is the rising black line.
So it all boils down to this really simple comparison. ROIC, what the company earns, WACC, what the company pays. And the golden rule is just common sense. You have to earn more than you pay. If you break that rule, you are in big trouble.
Now, let's look closely at that chart again. Follow the purple line, what they earn, and the black line, what they pay. For years, you can see them getting closer and closer. And then, right around 2020, it happens. The crossover. The purple line dips below the black line. At this moment, Reece has officially entered the value destruction zone. And the consequence of that crossover is absolutely huge. From that point forward, every single dollar that Reece invested to grow its business was actually making the company poorer. I mean, think about it in your own life. It's like taking out a loan at an 8% interest rate only to invest that money in something that pays you 5%. You are guaranteed to lose money. And yet the market, totally mesmerized by that rising blue stock price, just kept on cheering.
And this really gets to the heart of financial gravity. See, markets are always looking forward. They're betting on a future story. But you can't let a good story completely blind you to the mathematical reality of what's happening right now. A company that's actively destroying value just can't have its stock price hitting all-time highs forever. It's totally unsustainable. Something's got to give.
And as the source material for this whole analysis puts it so perfectly, the market's optimistic story, that narrative about growth and expansion, finally slammed into the hard, cold wall of the numbers. Narrative met gravity, and gravity won.
And if you look back at that blue line, you can see exactly when reality hit. Right at the peak, the story finally broke. The stock price rolled over and began its sharp fall back to earth. Because here's the lesson. You simply cannot compound negative returns forever. The math will always catch up to you.
So, what's the big takeaway from the story of Reece Limited? Why does any of this matter for you, whether you're a seasoned pro or just trying to figure out how all this stuff really works?
Well, here are the key lessons from this law of financial gravity. First, you have to watch for that gap between the story and the numbers. When they start moving in opposite directions, you should be skeptical. Second, remember that a rising stock price does not automatically mean a healthy business. They are not the same thing. Third, that crossover point we saw, when what a company earns falls below what it pays, that is a massive red flag. And finally, and this is the trickiest one of all, markets can ignore this bad math for a long time, but they can't ignore it forever. Eventually, gravity takes hold.
And all of this leaves us with one final question to think about. In the long run, when it comes to your own analysis and your own investments, what are you going to place your faith in? The power of a really compelling narrative or the inescapable pull of financial gravity?